So gold is moving like a crisis is coming, but Wall Street is acting like nothing is wrong. Central banks are buying at record levels, debt is exploding and the dollar is quietly losing support. If you own stocks, crypto or even just cash, this is going to affect you. Because whether you own tech stock, index funds, crypto, real estate or you are just sitting on cash, what gold is doing right now is about to affect every dollar you have. And I'm not talking about some slow moving trend that takes 10 years to matter. This is happening fast. Gold just delivered one of the most aggressive surges we have seen in decades. And here's why that matters. Gold doesn't move like this unless the system is flashing a warning sign. Gold is not supposed to behave like a meme stock. Gold is supposed to be boring, stable, predictable. But gold is acting like it just saw something the rest of the market hasn't processed yet. And here's the most terrifying part. Gold is screaming danger while stocks are partying at all-time highs. Those two things don't usually happen together. That's like hearing a fire alarm go off while the building manager is saying, "Relax guys, everything's fine." So by the end of this video you will understand what's actually driving this gold move, why the smartest money on earth is repositioning quietly, and what you should do before this goes mainstream. So the internet is loud and mostly wrong. If you go online right now, it's pure chaos. You have got gold bulls yelling that dollar is collapsing. You have got crypto people saying this proves Bitcoin wins. You have got the doomsday crowd stacking silver bars like society ends next Tuesday. The mainstream media, they are kind of ignoring it because gold making new highs doesn't fit the narrative that stocks only go up and everything is under control. But here's the problem. Everyone is looking at the same gold chart and everyone has a different explanation. That's why this feels so confusing. So let's filter the noise, and the easy answer of all this is inflation. Food is up, rent is up, fast food is basically a luxury experience right now. But here's what most people don't understand. If gold was purely reacting to inflation, gold would have exploded back in 2021 and 2022 when the money printing hit and inflation peaked. So instead gold didn't truly go into panic acceleration mode until later. So inflation is part of the story, but inflation is not the main trigger. Gold isn't moving like it's hedging grocery prices. Gold is moving like it's hedging trust, and trust is everything. So here's what actually driving it. To understand this move, you have to stop thinking like a retail investor and start thinking like the biggest players on earth. Retail investor ask, is gold going up? Institution ask, who is buying, how much and why? And when you look at the real buyers, you start to realize this isn't hype, this isn't retail, this isn't TikTok, it's central bank. And that should immediately change your level of attention, because when central banks buy gold, they are not buying because they want a quick profit. They are not buying because RSI is oversold. They buy gold for one reason: strategic survival. The dollar problem nobody wants to say out loud. For decades, the US dollar has been the backbone of the global financial system. It's the reserve currency, meaning central banks all over the world hold dollars to settle trade, stabilize their currencies, and keep their economies running. But something has been quietly shifting. About 20 years ago, central banks held roughly around 70% of their foreign exchange reserves in US dollars. Today that number has fallen to around 58%. Now listen, that sounds small until you remember what we are talking about here. Global reserves are measured in trillions, so that drop is not just a few percent. That is a global repositioning of massive wealth, and central banks won't call it dumping dollars. They'll never say that. They use the polite term diversification. The central bank gold rush, this is the proof. Now let's talk about the numbers that matter, because this is where it stops being opinion and becomes fact. So central banks have been buying gold at a record-setting pace. For the third year in a row, central banks purchased over 1,000 tons of gold per year, and that is enormous. And for comparison, in the decade before this buying spree, central banks were typically buying roughly 400 to 500 tons per year. So we are not talking about a normal increase, we are talking about a 2 times acceleration. And it gets crazier. In 1% quarter alone, central banks bought roughly 600 plus tons of gold. Think about that. In one quarter, they bought more than they used to buy in an entire year. So that's not diversifying, that's not small adjustments, that is an institutional stampede. So who's buying? Big countries, big reason, and you can see it in individuals examples too. Poland, for example, pushed its gold allocation higher, moving it toward the kind of numbers you see from countries preparing for uncertainty. China has also been consistently building its reserves, holding thousands of tons officially, and many analysts believe the real number could be higher, depending on what's not reported. And here's the key concept: central banks are price insensitive buyers, meaning they don't care if gold is at $2,000 or $2,500 or $3,000. They are not trying to buy the dip, they are trying to own an asset that doesn't depend on anyone's promise. Because gold isn't political, gold doesn't get sanctioned, gold doesn't default, gold doesn't need permission. It just sits there outside the system, and that's exactly why they want it. This creates a structural floor under gold. Here's what happens when massive central banks buy aggressively. They create a kind of permanent demand pressure, so even if retail investors get scared, even if traders take profits, you still have steady giant buying underneath the market. And that can push gold higher over time, even when people say it's already went up too much. Because the demand isn't emotional, it's strategic, which means gold can stay expensive longer than people expect. The part that should make you uneasy. Now we arrive at the part that makes this whole situation feel wrong. Stocks are near all-time high, tech stocks are priced like the future is perfect, AI companies are valued like they already replaced half the workforce. Everything looks optimistic, and at the same time gold is also at or near all-time highs. Historically, market picks one emotion, either risk on or either risk off. So in either risk on, stocks go up and gold relaxes, and in risk off, stock falls and gold rises. But right now we are seeing both. Stocks are pricing in a dream, gold is pricing in a warning, and bonds, they are pricing in confusion. This is exactly what market looks like right before reality forces everyone to pick a side. So the question is, what is gold warning us about? Because gold doesn't move like this unless it's front running something. And the central bank's buying proves it isn't a retail fad. This is big money preparing, quietly, relentlessly, and if you wait until it becomes obvious, you'll be reacting late. And this is exactly why gold is confusing people right now, because every major asset class is sending a different message. Stocks are acting like the future is unstoppable. Gold is acting like the future is fragile. Bonds are acting like nobody has a clue what the future will cost. So you get this weird environment where two smart people can stare at the same charts and walk away with completely opposite conclusion. One person says everything is fine, look at the S&P. Another person says we are heading straight into disaster, look at gold. So who's right? The honest answer is both and neither. Because what we are witnessing isn't a market that's decided, it's a market that's uncertain. There's real optimism about technology, productivity, innovation, especially AI. But at the same time, there is also growing anxiety about debt, inflation returning, geopolitical tension, and the long-term stability of the financial system. And here's what makes it even worse. Most people working in finance today don't even remember what real risk feels like. Let that sink in. The last true financial earthquake, 2008, was a long time ago, and when you walk into a modern investment firm, the average age is what, 25 to 40. That means a lot of the people pushing buttons today were either kids during 2008 or they were barely adults. They learned about the crisis from documentaries, not from experience, which means what? They are not scared enough. They are confident, they think they are smart. And confident people repeat old mistakes just with better marketing. That's why gold matters, not because it's shiny, not because it's traditional, not because it makes boomers feel safe. Gold matters because it's a signal. And gold doesn't send the kind of signal unless something underneath the system is slowly weakening. So the question is, what is gold actually warning us about? Gold doesn't rally like this when everyone feels safe. Here's the rule most investors miss. Gold doesn't spike when things look amazing. When trust is high, gold is boring. When stability is strong, gold gets ignored. When the world feels predictable, gold barely moves. Gold wakes up when confidence starts slipping, not collapsing, slipping. And what we are seeing right now isn't panic buying, it's something more dangerous. Preemptive positioning. Central banks aren't reacting to a crisis that already happened. They are hedging a future they don't trust. And when central banks start preparing for a future they don't trust, that's when you should stop scrolling and start paying attention. The debt math is becoming unavoidable. Now let's talk about the numbers that explain everything. The US national debt is sitting around $38 trillion, and that number isn't just large, it's accelerating. The US is adding debt at a speed that's hard to comprehend, roughly billions per day. And the real monster isn't even the debt itself, it's the interest. Annual interest payments have pushed into the $1 trillion range. Just interest. No highways, no schools, no military, no healthcare. Just the cost of carrying the debt. Think about how insane that is. At some point, debt stops being a number on paper and starts becoming a political and economic trap. Because how do you escape? Option A, raise taxes aggressively. Good luck with that. Voters will throw you out instantly. Option B, cut spending deeply. That's political suicide too. Option C, grow out of it, possible, but extremely hard when interest costs compound faster than growth. And option D is lower interest rates. Now we are getting close. Because lowering rates makes the debt easier to carry. And here's the key number. Every time rate drops, it can save hundreds of billions in interest over time. So naturally governments love the idea of lower rates. But what's the side effect? A weaker dollar, higher inflation pressure, and a loss of trust from foreign holders of US assets. So why central banks are quietly exiting the dollar dependence? Central banks used to keep about 70% of their reserves in US dollars. Now it's closer to 58%. That shift sounds small until you remember this is trillions in global reserve strategy changing. And central banks don't typically sell dollars directly. They hold US treasuries, that's US government debt, which means in simple terms, foreign nations are lending money to the US government and trusting that the value they get paid back in will hold up. But if they see a future where interest rates are pushed down for political reasons, the dollar weakens to make debt manageable, inflation rises again, and geopolitical trust is falling, then they do the rational thing. They look for a plan B, and plan B has one requirement: zero counterparty risk, meaning there's nobody on the other side of the deal who can fail, freeze, block, default, or change the rules. That's why gold wins. Gold isn't a promise, gold isn't a contract. Gold isn't dependent on a government's discipline. Gold is just an asset that exists outside the system, and the system right now is looking a little too creative. Why this matters even if you don't own gold? Now you might be thinking, okay, cool story, but I don't own gold, I own stocks. So here's why you should still care. Because gold doesn't move in isolation. When gold rallies like this, it usually signals something that eventually hits the dollar, inflation, interest rates, corporate profits, stock valuation, real estate affordability. Let's break it down simply. If foreign institutions lose confidence in the dollar weakens. If the dollar weakens, imports get more expensive. If imports get more expensive, price rises. If price rises, inflation returns. If inflation returns, the Fed has a problem. Because now the Fed either keeps rates high, hurts growth and stocks, or cut rate and risk inflation and currency weakens. So it's a trap, and traps are what gold loves. Because gold performs when policymakers have no clean solution. For example, think about money printing like this. Imagine a concert hall with 100 seats. That's it, no extra chairs, no extra space. At first only 100 tickets exist. Tickets cost say $50. Now suddenly the organizer prints 900 extra tickets. Did the concert become 10 times better? Did the hall grow bigger? Did the artist perform longer? No. Same seats, same music, same supply. So what happens? People fight to buy the same limited seats, and the price doesn't stay $50, it explodes. That's what happens when you create more money while the real world stuff stays the same. More money chasing the same supply equals higher prices. So what do you actually do with this information? Let me be clear, I am not giving you financial advice. I am giving you a framework, because in a world like this, the old playbook becomes dangerous. The old playbook was simple: buy stocks, hold bonds, wait 30 years, retire comfortably. That worked beautifully when debt was manageable, globalization was smooth, inflation was mostly dead, interest rates could stay low forever, and trust in the system was strong. But today, the rules are shifting. That means diversification isn't optional, it's mandatory. Because you are not just investing for returns, you are investing for survivals and stability too. So the way to think about this is stocks for growth and innovation, bonds, income assets for stability, but understand rate risk, real estate for tangible assets for real world utility, gold and silver as insurance against systemic stress. And I want you to understand the key point. So gold is not a growth asset, it doesn't produce cash flow, it doesn't pay dividends. Gold is type of insurance. You don't buy insurance hoping your house burns down. You buy it because if it does, you are protected. That's the role gold plays, not to make you rich overnight, to stop you from getting destroyed slowly. The hidden inflation most people miss. So one last thing, governments love telling you inflation is under control because inflation is low, sounds good, but look around. Even if consumer inflation numbers cool down, asset inflation is real. Stocks have been ripping, real estate surged for years, hard assets keep getting bid up. And when assets inflate, what happens? People who already own assets get richer, people who don't get left behind. And that creates social tension, political pressure, and even more solutions that involve printing or borrowing, which feeds the cycle again. So no, I don't know if gold goes to $5,000 or $10,000. Nobody knows. Anyone claiming they know is selling you a fantasy. What I do know is this: the forces driving gold are not short-term hype. They are deep, structural, and global. Debt rates, currency trust, geopolitics, and central bank behavior. And those forces don't disappear overnight, they build slowly, then suddenly. So, if gold is already acting like something is breaking, don't wait until the stock market finally gets the memo. Because by then, the repositioning won't be quiet, it will be violent.